was 6,000. How's that for a bearish call on the markets? We are at 12,876 right now. That is what Harry Dent, author of The Great Crash Ahead, is predicting by 2015. He says it's not the fiscal cliff, but another issue that will trigger the next financial meltdown.
But CNBC contributor Ron Insana is an optimist at heart, it says here. And he disagrees with Harry's prediction. Both join us now to make their case. How are you, Ron?
Hey, I'm fine. Why are you laughing, Bill?
It's not the Ron and Son I know, but at least you're bullish in this particular case here. Harry, is this a technical retest of the March of 09 lows that you're calling for, or is something fundamentally going to happen that's going to send us back down there again?
Well, again, the U.S. stimulated the last crisis with our subprime crisis, but the world was awash in debt, unprecedented debt, and demographic trends for the baby boom were set to slow. Now we got the same thing replaying with Europe set to be the trigger this time with their sovereign debt crisis. We've got even greater debt ratios now in most countries around the world, and demographics is getting ready to slow even more in the next few years. So I think we're primed for a crisis, but this time it's going to be Europe that triggers it, not our fiscal cliff, not our Fed. And if we could take the whole world down, Europe can take the whole world down. And think of it this way. We've had two bubbles, and now we're in a third one. Each bubble has taken us a little higher. Each crash has taken us a little lower. So 6,000 is simply the bottom trend line through those bottoms, including the 64.40 in early 2009, and it's just a slight new low. It's not anything that should be unexpected given the trends.
Well, it's still, half of where we are right now, and it's only a 2-year period. Ron and Sana, take the other side of that. What do you think?
Well, I think it's a pretty easy other side to take. I mean, with respect to the fact that the United States economy is actually getting stronger, I do believe we'll get a deal not only averting the fiscal cliff, but also getting us a big grand bargain on deficit reduction. We've seen a very strong pivot already from the nation's leaders on that very point. I think Europe is going through a very painful period, but I don't think they're going to be responsible for a global crisis. And I think if you look at the engines of economic growth, particularly here in the United States, housing is turning, manufacturing renaissance, a huge boom in conventional energy, technology also driving growth here in the United States. I don't see the ingredients, which I did in 2007, and Bill, you could back me up on this, for a major decline. I would be far more bullish. I mean, look, we're going to have a 5 or 10% correction around here, but I think that the fundamentals for the U.S. are quite positive in absolute and relative terms. I don't see us going back to 6,000.
Harry, I mean, we would have to see a disintegration of the European Union, the Eurozone, basically, to have that kind of an impact on the U.S. economy, wouldn't we? Is that what you're calling for?
Well, it's more than that. Even the U.S. economy alone is two economies right now. 80% of people never feel we came out of a recession because they peaked in their spending. Their house is underwater. 20% of people are college educated, very low unemployment rates. They've benefited from QE and the markets rising back. They peak later. They peak in their early 50s instead of their mid 40s. They're due, the wealthier part of our economy that's still 50% of spending is due to tailor off. The demographics in Europe just go off a cliff for many, many years to come. Yes, you can have nice little things in the economy and stimulus, but you can't get older people to spend money. And Europe has the worst problems because they have the worst demographics.
Yeah, listen, Robert Malthus, the economist in Britain, taught us that demographics do not have a very strong predictive value, and particularly when it comes to markets. Look, in 1998, Harry wrote a book saying the Dow was going to 35,000. In 2009, he wrote about the Great Depression that was ahead, and the S&P's gone up 110% off the lows, and the economy's gone to new highs in GDP, retail sales, and car sales have rebounded rather nicely.
I running for office?
No, absolutely not. But I would not predict stock market trends based on some of the factors that Harry cites.
Hey, Ron, you and this guy don't know what you're talking about. The correlation with a 46-year lag on the birth index with the economy and the stock market is unbelievable. We said in 1992 that the economy would top around 2007 and we'd go into a 12 to 14-year downturn. We predicted with demographics against the grain that Japan would collapse from 1990 forward back in the late 80s, and nobody saw that coming. Demographics is the ultimate leading indicator. People do predictable things as they age, and they peak in their spending at age 46, and they spend less the rest of their life. You cannot fight that with a generation the size of the baby boom with stimulus. No, you cannot.
Sure you can.
I'll bet you on that in the next year. You cannot.
Happy to bet it, but the thing is,
Japan didn't fight it. Ron, how did Japan's market do? Their baby boom peaked in the early to mid-'90s, and they've been down and lower lows in their stock market for years and years and years, despite $5 trillion in stimulus.
And we behaved nothing like Japan. They started their quantitative easing programs.
No, we're doing the same thing as Japan.
No, we're not. We're not remotely close. No.
They did endless QE.
No. First of all, they were 5 years late to start the quantitative easing process, 5 years late to start the zero interest rate process.
But they've been doing it ever since. They're doing it today.
We have not gone straight down. In fact, our market has behaved radically different from that of Japan. So has our economy.
2008 to 2009 wasn't straight down?
Oh, no, 2007 of October 2007 to 2009.
It's gone down and up for 20 years.
Guys,
23 years.
It's
always gone lower.
How about a near-term question? The market is so focused on taxes right now, and we're looking at anticipation of higher taxes, and so that has triggered so much selling. Do you expect more year-end selling? How much further does this market go down over the near term, going into year-end, given the fact that we don't know where tax rates are going to be yet, and we're waiting on the fiscal cliff fix?
Well, I would bet that we have, something of a 10% peak to trough correction here. And once the game gets a little clearer, and listen, I talked to one operative that's close to the Obama administration today who suggests the president's willing to compromise if the other side is. I think they cut a deal averting the fiscal cliff. I think they do a Simpson-Bowles-style tax reform and entitlement reform package will be very stimulative to the U.S. economy. And baby boomers will continue to spend throughout their lives. They're going to work longer. They're staying in the workforce longer. They absolutely will. They have to.
They will not.
They won't.
I will say they will not, and I will stand by that for the next 10 years. Our forecast, real quickly, I actually see the market rallying into year-end. I do think the fiscal cliff's probably going to be dealt with. I see a crash after that. Somewhere between December and February, I think news, slower economy in the U.S. from baby boomers and more problems in Europe cause us to start to go down.
At least we got an agreement.
Economy accelerates in 2013.
All right, well, at least we got an agreement to the end of the year on the fiscal cliff. We'll stop right there on that one. Thank you, guys.
Thanks.
See you later.